The top 10% of earners in Taiwan take home 48% of total income. The bottom 50%? 12%. And here's the twist. Taiwan just posted 7.2% GDP growth for 2025, the highest in over a decade. And the government raised its 2026 forecast to an extraordinary 7.71%. On paper, this is one of the best performing economies in Asia. In reality, it's one of the most unequal.
Welcome back to Asia Tech Macro. I'm Maya, and today we're looking at a story that's been hiding in plain sight. Taiwan's economy is booming. Exports hit an all-time record of $65.77 billion in January 2026 alone, a 69.9% surge year over year. The trade surplus doubled from $67 billion to $122 billion, equivalent to more than 15% of GDP, one of the largest current account surpluses relative to GDP in the world. But beneath these spectacular headline numbers, there's a K-shaped split that's getting wider every quarter.
Let me define what we mean by K-shaped. The upper arm of the K is the semiconductor and AI technology sector, which is absolutely on fire. TSMC alone manufactures over 90% of the world's advanced AI chips. Its market capitalization hit $2 trillion in February 2026. TSMC now makes up roughly 45% of the entire TAIEX stock index, triple what it was a decade ago. The company uses about 9% of Taiwan's total electricity, and by 2030, the semiconductor industry will consume twice as much electricity as all of New Zealand.
45% of the stock index in one company? That's an extraordinary level of concentration.
It's the most concentrated major stock market in the world. When TSMC shares move, the TAIEX moves. When TSMC reports earnings, Taiwan's GDP revises upward. The entire macroeconomic narrative of Taiwan is essentially a TSMC story with side characters.
And what's happening on the other arm of the K?
The lower arm is Taiwan's traditional industries, which employ roughly 60 to 70% of the total workforce. These are manufacturing, machinery, textiles, small and medium enterprises, and they're struggling. In September 2025, the Ministry of Labor reported more than 6,000 workers on furlough, with the machinery and equipment sector hit hardest. These industries are facing a triple squeeze: U.S. reciprocal tariffs under Section 301, China-related overcapacity in competing products, and an inability to compete for talent against the semiconductor sector, which pays significantly higher wages.
So the majority of Taiwan's workers are in industries that aren't benefiting from the AI boom, while a small number of TSMC and related tech workers are driving the GDP numbers upward.
That's the K. And it gets worse when you look at the housing market. The price-to-income ratio in Taipei is 16 times average annual income. Nationally, it's 9 times. An average person in their 20s or 30s earns between 35,000 and 45,000 new Taiwan dollars per month, while an apartment in Taipei costs over 10 million. To save for a 20% down payment, a young person would need to save nearly all of their income for more than a decade.
That's basically impossible.
A survey by Housing Movement found that over half of respondents aged 25 to 40 said they considered homeownership hopeless in this lifetime. 50% of young people in that age group still live with their parents to save on housing costs. The housing crisis is directly linked to Taiwan's catastrophic fertility rate, which is one of the lowest in the world because young people are delaying marriage and family formation for economic reasons.
So Taiwan's AI chip boom is creating extraordinary national wealth at the macro level, while making life increasingly unaffordable for the majority of its citizens at the micro level. That is a textbook K-shaped economy.
Let's dig into the energy and water crisis, because this is where the K-shaped problem becomes an existential risk for the semiconductor industry itself. Alex, you mentioned TSMC uses 9% of Taiwan's electricity. Walk us through what's happening on the energy side.
Taiwan is heading toward an energy crunch that could threaten the very industry that's driving its growth. The island is highly dependent on imported fossil fuels. About 97% of its energy comes from imports. Taiwan shut down its last operating nuclear power plant in 2025, and the government's renewable energy target of 20% of the energy mix by 2025 was missed. They've extended the deadline to end of 2026, but most analysts are skeptical they'll hit it.
Wait, they shut down their nuclear plants while semiconductor power demand is exploding?
I know. The irony is painful. The Taiwan Semiconductor Industry Association issued a rare public warning about critical power shortages that threaten the island's chip manufacturing dominance. Over the last 7 years, Taiwan has experienced 3 sizable power outages, with additional smaller disruptions in the past year. For a semiconductor fab, even a momentary power disruption can destroy millions of dollars of work-in-progress wafers. TSMC has spent enormous amounts on backup power systems, but the structural problem remains.
And by 2030, the semiconductor industry will use twice as much power as New Zealand. Where is that power supposed to come from?
That is the multi-billion-dollar question. The Atlantic Council published an analysis noting that the Iran conflict is testing Taiwan's energy resilience because Taiwan imports significant quantities of Middle Eastern oil and LNG. Any disruption to Gulf shipping routes directly impacts Taiwan's energy supply, and by extension, the world's supply of advanced AI chips. It's a geopolitical vulnerability that most investors don't fully appreciate.
The water situation is equally alarming.
Water is the other critical constraint. Semiconductor manufacturing requires enormous quantities of ultra-pure water. TSMC's water demand could double from 2022 levels by 2030. The Jamestown Foundation published an analysis warning that poor water supply management could cause TSMC's output to drop as much as 10% from their 2030 forecast. TSMC has invested in its own water recycling plant in southern Taiwan Science Park, producing 10,000 tons per day, with plans to increase to 36,000 by 2026. But that may not be enough.
So Taiwan is simultaneously the most important island in the global technology supply chain and one of the most resource-constrained places on Earth for the exact resources that semiconductors need.
That tension is the story, and it ripples outward in ways most people don't consider. The U.S. tariff deal with Taiwan, where the U.S. cut tariffs from 20 to 15% on Taiwanese goods, was explicitly linked to TSMC expanding operations in America. The deal exempts about 2/3 of Taiwan's exports, mainly semiconductors and computer products, from tariffs. But in exchange, TSMC committed a staggering $165 billion to its Arizona operations. That's not just an investment, it's an insurance policy for the U.S. against Taiwan's energy and geopolitical vulnerabilities.
So the U.S. is essentially saying, we love your chips, but we don't trust your energy grid or your neighbor across the street.
That's a blunt way to put it, but essentially yes. And this creates a fascinating dynamic. Every dollar TSMC invests in Arizona is a dollar not invested in Taiwan. Every advanced node that eventually moves to U.S. soil is a slight erosion of Taiwan's silicon shield. The Taiwanese government understands this tension. That's why they maintain the N2 rule, ensuring the most cutting-edge technology, currently 2 nanometer, stays on the island.
But if Taiwan's energy grid can't support the power demands of those cutting-edge fabs, the N2 rule becomes academic.
Exactly. The energy constraint could force TSMC to accelerate offshore expansion, not because it wants to, but because Taiwan physically cannot provide enough power and water for continued domestic scaling. And if that happens, Taiwan's entire economic model, which depends on being indispensable to the global semiconductor supply chain, starts to weaken.
That is a scenario that I don't think markets are pricing in at all.
Contrarian corner. The consensus view on Taiwan is very nuanced. Bulls point to the extraordinary GDP growth, TSMC's dominance, and the AI boom. Bears point to the China threat, the energy crisis, and the inequality. But what's the contrarian angle that nobody's talking about?
My contrarian thesis is this. Taiwan's K-shaped economy might actually be a feature, not a bug, from the perspective of national security strategy. And here's my logic. The reason the United States, Japan, and Europe care about Taiwan's security isn't because they love Taiwanese democracy, although they say they do. It's because they need TSMC's chips. As long as TSMC is irreplaceable, Taiwan is protected by what analysts call the silicon shield.
Okay, so you're saying the extreme concentration of Taiwan's economy and semiconductors is actually a defense strategy?
Think about it. If Taiwan had a diversified economy where semiconductors were only 10% of GDP, the geopolitical calculus of defending the island would be very different. But when TSMC is 45% of the stock index, over 90% of advanced AI chips, and critical to every major U.S. technology company, the cost of losing Taiwan becomes catastrophically high for the entire Western alliance. The K-shaped economy, where everything depends on semiconductors, is what makes Taiwan worth defending.
Wait, that's a really provocative argument. You're saying Taiwan benefits from being economically vulnerable because that vulnerability is also its leverage.
It's a paradox, but I think the data supports it. Every time TSMC announces another record quarter, every time NVIDIA says it needs more CoWoS packaging capacity that only TSMC can provide, the military cost of losing Taiwan goes up. The inequality problem, the housing crisis, the struggling traditional industries, these are real human costs. But from a cold geopolitical calculus, they're irrelevant to the silicon shield. What matters is that the chips keep flowing and that nobody else can make them.
But doesn't the energy crisis undermine this? If Taiwan can't power its fabs, the silicon shield weakens regardless.
That is the genuine risk that threatens the entire thesis, and this is where I get genuinely uncertain. If Taiwan solves its energy problem through a combination of LNG imports, offshore wind, and possibly restarting nuclear, the silicon shield holds and the K-shaped economy continues as a necessary price. If Taiwan fails to solve the energy problem, TSMC is forced to accelerate offshore expansion, and the silicon shield gradually dissolves.
There's another dimension to the contrarian read that I want to raise. DBS Bank forecasts Taiwan growing at 4.8% in 2026, the fastest among Asia's newly industrialized economies. Capital Economics says the economy will keep flying, but Academia Sinica, Taiwan's most prestigious research institution, projects only 3.71%. That's a huge range for such a well-analyzed economy.
The range tells you something important. The high forecasts are essentially TSMC forecasts. If AI demand continues to accelerate and TSMC keeps operating at full capacity, Taiwan grows at 5 to 8%. If there's any slowdown in AI capital expenditure or any hiccup in TSMC's production, the number drops to 3 to 4%. There's almost no middle ground because the economy is so concentrated in one sector.
That's an incredibly fragile growth model. One company's quarterly earnings essentially determine whether an entire economy of 23 million people has a good year or a bad year.
And that fragility is what makes the K-shape so dangerous in the long run. The young Taiwanese person who can't afford an apartment isn't benefiting from TSMC's $2 trillion market cap. But if TSMC ever stumbles, that same young person's non-tech job is at risk because the entire economy contracts. It's an asymmetric relationship. The tech boom's gains are concentrated, but its potential losses are socialized.
Concentrated gains, socialized losses. That's a very clear way to put it. And it describes a lot of economies we've covered on this show, actually. Action items. Given Taiwan's K-shaped reality, what should investors and business professionals actually track?
3 specific actions. First, monitor Taiwan's energy infrastructure developments as the most underappreciated variable affecting the global semiconductor supply chain. The government's renewable energy target of 20% by end of 2026 is the immediate benchmark. If they hit it, it signals credible progress towards supporting growing semiconductor power demand. If they miss it again, as they missed the 2025 target, it validates the concern that Taiwan's grid cannot support continued fab expansion. Track Taipower's capacity addition announcements, any policy reversals on nuclear energy, and LNG terminal construction timelines. The Atlantic Council and Global Taiwan Institute publish regular analyses on this topic. Any announcement of TSMC investing in power generation infrastructure itself, which they've already started doing with solar installations at fab sites, is a signal that the company doesn't trust the national grid.
Second,
watch the gap between Taiwan's tech sector employment and traditional sector employment as a leading indicator of social stability. The Ministry of Labor's furlough data, which showed over 6,000 workers on furlough in September 2025, is published monthly. A rising trend in furloughs, particularly in machinery, textiles, and small manufacturing, signals that the K-shape is worsening. Cross-reference this with the government's plans for 1 million social housing units by 2032 and any new affordability measures. If the housing price-to-income ratio in Taipei stays above 15 times while real wages for non-tech workers stagnate, social pressure on the government will intensify. Taiwan has local elections in November 2026, and housing affordability is likely to be a major campaign issue.
and third,
track the concentration risk in the TAIEX as a portfolio construction signal. With TSMC at 45% of the index, passive investors in Taiwan ETFs are essentially making a single stock bet. The FTSE Russell team has published research on balancing sector exposures in Taiwan precisely because of this issue. If you have Taiwan exposure through broad emerging market or Asia ex-Japan indices, quantify your effective TSMC position. Many investors are surprised to discover that their diversified Asia allocation is actually heavily concentrated in one company. The signal to watch is whether TAIEX implements any weighting caps on individual stocks, similar to what some other exchanges have done, which would force rebalancing and potentially create volatility.
The big picture takeaway for me is that Taiwan is a microcosm of a broader pattern we see across Asia. Incredible top-line growth driven by the AI and semiconductor boom, but with the benefits concentrated in a narrow slice of the economy, while the majority faces stagnant wages, unaffordable housing, and structural challenges that the headline GDP numbers completely obscure.
And what makes Taiwan's case uniquely important is the geopolitical dimension. This isn't just an inequality story, it's a national security story. The concentration that creates the K-shape is the same concentration that creates the silicon shield. Taiwan's leaders have to simultaneously maintain semiconductor dominance, solve an energy crisis, address a housing catastrophe, and navigate the most dangerous military standoff in Asia, all while 45% of the stock market is in one company.
That's an impossible balancing act.
It might be. And the question of whether Taiwan can pull it off has implications far beyond its 23 million citizens. If Taiwan's silicon shield holds, the global AI boom continues on its current trajectory. If it cracks through energy failure, social unrest, or geopolitical escalation, every technology company on Earth has a problem.
And if you want the full data breakdown, the energy analysis, the housing affordability numbers, and the TSMC concentration data, we publish a free daily newsletter at asiatechmacro.substack.com. Everything we discussed today is in there with sources and charts.
Coming up next, we're going to examine how Asian central banks are navigating the dollar strength dilemma. The BOJ, RBI, Bank of Korea, and Bank Indonesia are all making very different bets on interest rates and currency management. The divergence is creating opportunities and risks across every asset class.
That's going to be a really important one. Thanks, everyone.
Stay data-driven. Bye.